Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right, really excited for my guest today. I've got Julia Wilkinson. She brings in 2 decades of global investment experience. She's a leader at Lebec Capital Partners. She's shaped both by her roots in Mexico City and her hands-on portfolio construction work across Latin America. She has overseen investments in everything from private equity to real estate to impact-driven blended capital strategies. And at Lebec Capital Partners, she leads the investment frameworks and strategy for complicated private portfolios. She manages due diligence and champions values-aligned investing. She's a veteran in the investment management space and in Wall Street. She worked at Goldman Sachs doing direct experience, essentially capitalizing startups. And that's allowed her to speak candidly about balancing rigorous financial modeling with pragmatic solution-oriented management. With her cross-cultural insights and track record spanning institutional and venture investments, Julia offers a lot of insight to look into navigating not just asset classes, but also the operational realities and impacts behind them. So Julia, welcome to the show. I'm excited to have you here. And it was a, great surprise to know that you know some of my friends already. So it's a small world. So thanks for coming on.
Thank you, Joel. It's so nice to meet you. And it's an honor to be on your show and share a little bit more about our vision and connect with you on yours.
Yeah, likewise. Well, I'm very confident that our community is going to learn a lot and just get a lot of inspiration from what you've built and also your career. But, all of us have gotten to where we are through a journey, and all of us have different journeys, right? I mean, our common friend started with a non-traditional journey as well. So talk me through who Julia was maybe in high school and kind of your early upbringing, maybe some of your influences growing up. And I've seen everything and I've heard everything. I've had private equity fund managers that grew up in fast food. Their parents were entrepreneurs buying franchises. And, at the age of 7, they're, doing P&L. So walk me through kind of some of your early influences and maybe not even investing, but even entrepreneurship and building businesses, because that's the heart of investing, right? Backing businesses, backing real estate projects. So walk me through that and kind of your formative years. And then we can talk through your Ivy League education, going through some of these top schools and, how that's influenced you as well.
Amazing. Thank you, Joel. My journey definitely started in my childhood into getting me into where I am today. My parents were both U.S. diplomats, so their careers were very much focused on the government side of things. However, they really worked a lot on the intersection of environment, politics, and social issues. And often, particularly at the dinner table, we would debate how these things worked, what's the best approach. Often we had different opinions, which was also exciting. And we thought about the world differently, which really helped me also frame my own views. And my mother was the environmental counselor actually in Brazil and in Mexico, which essentially kind of has the role of negotiating and working with USAID and other agencies at the time on thinking through programs to protect some of the world's natural resources, which were even in the 90s considered kind of globally valuable, such as the Amazon or the sea turtles of the coast of Mexico. All of these were thought of as kind of like had a value to society that needed to be protected. At the time, it was mostly nonprofit government agencies and diplomatic forces that were kind of working to resolve this with local agencies, of course, like the Brazilian government. But the private sector was not so actively involved. And yet we talked about creating sustainable supply chains, particularly around communities like in the Amazon, where forestry was one of the major threats, as well as agriculture in general, and kind of understanding like, how do you make people feel that they have enough opportunity while still protecting the natural resources around them? So that got me really thinking and about, how do we innovate in that way? And I was already brainstorming with my mom, like, how can we buy this land? How do we protect it? And she's like, It's not as simple as it sounds. But this got my wheels turning. And at the time I was in Brasilia, at an international school where I got to also meet people from all around the world with very different experiences, also diplomats' kids, local people as well. And that also gave me, sort of the outsider's lens to reality, which I think, having moved a lot, shapes my view of the world. Like, it's hard to ignore inequality or ignore things that are not necessarily in your comfort zone,
Sure.
where maybe you got normalized to it, right? So change and being the outsider kind of gives you a unique vision of some of the challenges societies face, some of the things that bring us all together, right, that we have in common. And that always set me in a sort of unique way to think about the world differently, let's say, than perhaps some of my peers who grew up in the same place. Not to say that that's, not even equally as good. But I think it was harder for me to ignore some of these systemic issues, and I became very passionate about them, even though I didn't immediately enter a purely impact-oriented career. As you mentioned, I later ended up working at Goldman Sachs in sort of my first Wall Street career, right in 2007, before the financial crisis. And actually, that was in private wealth management, not direct investing. We were building portfolios and investing for clients, particularly in Latin America, Brazil. And that really was also an exciting way to understand how the high net worth individual thinks and allocates, but also having worked almost right through the crisis and on through, mid 2013 or 14 at Goldman, seeing how when risks are taken in the market that are not necessarily also aligned with the public good, it can cause, a global crisis. So that also reinforced some of this passion that I later had on aligning financial systems with social and environmental good. But I'll pause there and we can kind of break down any other parts of that you like.
Yeah, look, I mean, we've, through our fund accelerator, we've had a bunch of funds that were investing in climate, they're investing in impact, and we've seen some, troughs and peaks, with that space, especially with administration changing too. And many of them have pivoted into more of the hard infrastructure, which I think is still going to continue to grow. Obviously, we've got, Jeff Bezos investing in Prometheus, right? Just kind of investing really in the future of physical AI and hard tech. So robotics, manufacturing, logistics, a lot of those are still going to be really powerful in terms of like the impact value chain. So I think it's like, the impact is still there. It's just maybe some of the initiatives have kind of transitioned into more of the picks and shovels. But I would love to hear your opinion on that in terms of kind of the administration and how some of these impact funds have changed. I don't know if you've seen any change or if any people have had challenges, raising capital, but always good to hear a friend's perspective on that.
Yeah, absolutely. I think, taking a step back to, where has the market gone from where I was referring to just now at the financial crisis. I think
Sure.
the financial crisis was kind of, I would call, the first step towards mainstreaming what we might call impact into financial markets, where we realized that there were misaligned incentives, lack of transparency in financial markets, risk taking that was unmitigated, and putting, insurance companies and whole markets at risk. And that was very localized in some ways to the US, and yet it was globally contagious because of how powerful our markets are. So the subsequent result was a whole lot of regulation, a whole lot of shifts in the way financial systems are organized. In fact, right, most investment banks became banks. Executive comps were controlled, because, in some ways we even had what would be the threat of breaking up all these institutions or reconsolidating, as they ended up having to be, essentially. But all that to say that was sort of the first move of, look, we can't have unmitigated kind of Wild West Wall Street behavior and not acknowledge that the ramifications can be a global crisis that took 10 years, arguably, to resolve, that also led to artificially low interest rates, right? Which also venture boom, which were just being declined because interest rates went up after all this period, due to hyperinflation and all the things that happened from COVID. So all that to say, I only bring that back to that because I do think that we have to remember that there is a real systemic risks behind ignoring inequality, behind rampant risk taking. They can affect the global market. So I think whether it's a priority in everyone's mind today or not, due to all the things we will further discuss, the underlying risks remain. So that's one. I think we saw another hype bubble during 2020 around ESG and sort of like impact in general, where people were excited that people were getting into it. There was a marketing bubble, as well as sort of a, even under Biden administration, there was sort of a, you can't just name something an impact strategy and not actually be delivering some kind of rigorous financial and impact strategy behind and measurement behind it, and actually executing this throughout the investment cycle, and not just calling it something and charging more for it, as well as, kind of the pushback from enterprise, where it's, that we're seeing now, perhaps like big business, oil, others that don't want to be controlled or threatened by an overarching regulatory system. Where we'll end up, inevitably we'll be back somewhere in the middle, because reality, climate change risk, inequality risk, energy demand, all these things, heat waves that we're seeing in Europe, those are real. They're still happening, and they're still costing a lot of money to society. And so you're absolutely right. We're seeing more like, where can we see in the climate, or let's say in any impact space, we're seeing kind of a retrenchment, like those who are truly committed are staying, right? Those who are doing it perhaps because it was trendy, or perhaps, another business revenue stream, not necessarily their core business, maybe have moved away. But I think that we're still seeing growth year over year in what we call true impact investing management. So I think we're at 1.7 trillion in a global space, where we truly call that like investors who are looking at traditional, purely financial return, and also measuring towards impact.
Sure. No, that's really helpful. You also talked about private wealth management, and also just kind of the ecosystem in LATAM. I've been fortunate to build some really good relationships with other family offices and institutions globally, specifically in LATAM. And, it's been interesting to kind of learn how they think about compounding capital and also preserving capital. So would love to hear some insights in terms of maybe some of the observations that you've seen in terms of, private wealth management, asset allocation, how that region looks at portfolio construction, and then also the evolution. So when you think about firms like Thoma Bravo, right? I heard the founder speak maybe about a year ago, and one of the things he was talking about was early on. He started out in banking, and when he started out, software wasn't really a space where you think about private equity. It was really kind of early stage, and then kind of hopefully later on it's either just growth equity and buyout at the really, really later stages in the secondary. But, I think they were one of the leaders, specifically Orlando. I think he was originally from Puerto Rico, but, his focus was really software private equity, and really being one of the trailblazers, focusing on that niche and just kind of really capitalizing on the scale that software provides. So I guess my question to you is kind of, how have you seen that evolution of family offices, allocators, private wealth management, and now kind of bleeding between, venture growth equity and buyout, specifically in like the software and tech space, now that we've got, the biggest IPOs that we've ever seen?
Yes. Well, so many interesting questions there. So first on LATAM, I think for my experience with Latin American allocators, particularly Brazil, which was one of my focus areas, is that they have gone through many decades of hyperinflation. They also have seen revamped the financial system to be more transparent, everything cleared through the central bank. They've had challenges with commodities markets and other things. So they're to see commodities risk differently than U.S. investors. And they often, at least the ultra high net worth, have a pretty sophisticated family office structure, hiring professional teams, managing multiple banking relationships, kind of going back to or financial risks and markets, like having seen banks collapse, having seen inflationary crashes, they tend to spread their risk more across institutions.
Yeah.
And like have a little bit more of investment outside of Brazil, in fact, than perhaps onshore due to the currency risk and some of the other, ongoing instabilities in the regions. However, from a sort of impact perspective, or, people are often committed to like the country's growth, development, finding ways to also invest locally in like the emerging technology ecosystem. So Brazil, speaking of venture, in some ways was way behind the US on the matured Silicon Valley like market, but has started to really catch up. Even in the past 15 years, we've gone from, a handful of VCs in Brazil to many that have succeeded, scaled. Another classmate from my Brasilia days has gone on to form many VC funds in Brazil and Silicon Valley that have succeeded. So we're seeing also this sort of shift from thinking of Brazil as uninvestable, unscalable place for tech to being one of the hot markets for both local and international investment. So that's very exciting. And also this added uniqueness of its environmental power, its renewable power, it's kind of like large commodities businesses, makes it also one of the largest economies in the world, of course. So there's a lot of opportunity there on the broader tech side. And I think, going back to technology as both a force for good and perhaps a risk. I think, when we started talking about this podcast, we were also, I was brainstorming sort of what we're seeing now. Yes, for example, SpaceX is the biggest IPO in history, right?
Sure.
However, there's a lot of risk embedded in both their business model. Someone was pointing out that most of what is actually a revenue source today is either Grok or the satellites, but both of which are not necessarily generating a lot of money. And what are we really getting out of this, and how much energy and demand on the grid is this also placing, while we're not really thinking consciously about how we're implementing a renewable strategy there. We're already seeing the price fluctuate quite a bit. I mean, it's still more or less flat from the IPO, but it's down quite a bit. So the question is, will it sustain? Will it really prove its value? I was remembering when in preparation for this interview that about 15 years ago, I think this was 2012, MIT published on the cover of their technology review, it said like, we were promised colonies on Mars and all we got is Facebook. And I feel like we're kind of there again.
Sure.
And so let's see, at what cost, and to whom is that cost? But I am, of course, excited. I'm also excited about the power of what this technology can bring to energy management, to health, to water management, right? These are actually metering, resource planning, grid optimization. I'm actually more excited about those applications than the Gen AI and kind of like what I think is a little bit less proven to be truly a productivity additionality and more consumptive than it is perhaps productive. But we can go into that in more detail as well. And I'd love to hear your thoughts.
I mean, I think what is interesting as a founder is someone that can kind of really think through what are all the different spokes in the wheel that are going to help us live on Mars, right? I mean, so obviously you can't do an ACH transaction. There's no Bank of America on Mars. So if you've got Twitter platform that has a crypto rail, maybe you can send money that way, and it doesn't matter where you live. If you think about transport, maybe the Boring Company kind of helps to kind of get around quicker underground. There's no friction. And then obviously if you want to beam Wi-Fi, you got the Starlink network. So I think, kind of thinking about how you can vertically integrate things. And then obviously you can, if you don't have petroleum, you could find ways to generate electricity, whether it's with, obviously not with water, but maybe there's other types of friction or methods to kind of create electricity. And if you can run on electricity, you can have automobiles and machines and robots that can do work or do construction. So I think that's kind of interesting. So I think it's kind of, thoughtful how, you see a founder maybe once in a century that can kind of think through that entire stack. And it'd be interesting to see the next founder. And the whole use case is, how do we live on Mars? But I think there could be another entire stack to kind of really reinvent something else. Like, maybe we all live underground or something, and
Yeah.
there's a way that you can do that. So the entire stack for that, or just kind of some other type of massive application. And I'm still trying to process all of this and think through it. But I think, all of us, in my mind, I think the first breakthrough that we saw maybe about 8 years ago or 9 years ago was like seeing the Uber kind of show up on our phone. And
True.
I think that happened again with ChatGPT, where you can kind of type something. And for me, it's like you can type something and build an entire website or an app. So I wonder what the next norm would be. Now it's like, and I don't know if you feel this, but I remember I feel like a dinosaur when I actually had to go on Google to write an investment memo. I'm like, look, let me go on Google and research some articles and cite those articles and actually manually write a paper myself, where people just type in a couple prompts and they have an entire memo written out, right? So I wonder what that next norm is, where, like, I don't know, maybe you're thinking about childcare, you're worried about childcare, but there's a robot that is handling childcare for you, or a network of robots that handle different shifts. But my question to you is, like, what do you think the next wave is that's going to give you that aha moment, or have you seen something recently?
Yeah, well, I think for us at Lebec, we are most excited by the possibility of a livable future continuing on this earth, while still perhaps being able to go to other planets.
Yeah.
So I think there is an important, what is more important today to solve? Is it more important for us to get to Mars today when we have no livable resources there? Why aren't we focused a little bit more on solving systemic issues that would protect us from having to live underground, or any of these doomsday outcomes, which I know, we want to prepare for, and we want to be realistic. And this is, a resource constrained world. There is, weapons. We are seeing heightened multipolarization and a breakdown in multilateralism, which unfortunately, even though my parents met at the United Nations and I'm a UN baby,
Sure.
we're seeing this breakdown. So I see why people are reacting with, okay, we have to find this backup plan. But for us, the most exciting is, in two scenarios. One, we are in a world that's heating faster than we had anticipated, so there will be impacts.
Sure.
Those are called, what we call adaptation to this reality, whether it's one of these geopolitical crises or the heating world. We're excited about, like, how can we find technologies, not just new technologies, because we don't just do venture, but also how do we replicate existing scale, the less sexy solar panels, which are now 90% cheaper than any other form of energy, while optimizing perhaps this is, I think, could tie nicely to kind of like the excitement around AI, distributed energy, right? Like right now we're building these like utility scale, not well planned, in the middle of a burning desert, like heating it up even more, not even thinking about the community, creating all kinds of expensive backlash. When, yes, it would take a little more thought, a little bit more effort, but you can actually distribute energy now. Like cars have a ton of energy if they're electric, right? Their batteries are huge. The F-150 can power your home for 3 days. Tell me why I can't do this at scale from a distributed way and power the AI grid. And Milken said this well recently in an interview, like, if these big AI companies really want to win over the transition and they want to take all the energy from the existing grid, right? Because they're really, literally, it's like, take it, give it to me. Don't forget the citizens. We need as much power as possible to power these centers. Okay, then invest a lot of money on getting these people to be part of your distributed energy grid, which means they need solar, they need EVs, they need a power wall, they need a battery storage at their home. Plug them into a high-end AI-driven grid optimization software, which a lot of these big players are investing in, right? Energy Impact Partners, which is backed by literally every major oil and gas and utilities company are investing in these things. VCs across the spectrum, Chris Sacca, Lower Carbon Capital, Lucas Walton, all of them are looking at this as part of the way to power a clean transition. But I think, to me, distributed energy, that grid optimization, and the future of like, this ties into autonomous vehicles too, right? You need a very connected city that can deal with waste management better, cars moving autonomously, charging. Like I was just walking by one of these charging centers for the autonomous vehicle Waymo, and it was so hot because it's like they have such large batteries for their string processing capacity.
Sure. Yeah, all the sensors.
The sensors, so it's like
Yeah.
1,000,000 degrees. So
Oh,
it's
yeah.
just like thinking of that in a more strategic way and planning and using both physical assets. So I think this is where, like, you know, it's a little bit more less sexy than traditional venture. A lot of this real world physical hardware doesn't have the 10x return that we're looking for, and yet it is necessary for this sort of integration of energy transition of the future.
And it's capital intensive, so that also introduces a significant amount of risk too. So
yes, which maybe is a good segue for like what we do at Lebec and what is innovative finance, because Lebec, founded by Alix Lebec, who's our amazing CEO, and one day you'll have her on your show perhaps too.
Would love to.
She came from an organization she helped build called Water Equity, which is an asset manager founded by Matt Damon, the actor, and Gary White. And they invest in water access in emerging markets. And by invest, I mean it is a for-profit vehicle, although they are a nonprofit asset manager. And they have not only raised $500 million over the past several years, or maybe even more at this point, but they've managed to outperform expectations. They did create a blended vehicle in the first strategy. And we can talk a little bit more about what that is, but that inspired her to leave Water Equity and bring this playbook to the market at Lebec, which we are basically an innovative finance firm and company. We're scaling innovative finance to solve the world's largest problems today. There's a $5 trillion capital gap annually to solve the basic issues that we're discussing: access to water, energy transition, you know, health, fair, clean air, etc. And that number comes from McKinsey and BCG, and that's pretty much on the low end.
Sure.
At the same time, we are seeing demand from the next generation, millennials, even corporations and philanthropies, everyone who's seeing the risks in their portfolio, saying, like, how do we do more? And yet, to your point, there is sort of a mismatch in times and risk and return demand. And then we also have philanthropic capital sitting over here, playing a role where it can de-risk some of these other for-profit strategies that we're discussing. What we call innovative finance is really using every tool in the capital stack, from philanthropy to market rate, at the right time for the right thing. There's no one size fits all, right? Like, the energy transition is complicated. Health in different regions has to be dealt with differently.
Sure.
Regulations create problems for distributed energy in the US because it's, you know, each state has a different market. You know, these are all factors that require a unique set of tools. And sometimes that tool is patient capital, you know, coming in and taking some of that CapEx risk that a VC won't take. Or it's a, you know, asset-backed lender in Europe saying, I'll lend to install these batteries, and you, the holding company, can, you know, operate however you want, and we own the asset and it's collateralized. You know, these are different approaches to solve what you're describing, is the perhaps wrong investment tool to invest in a specific, you know, impact strategy. So that's why we have both a strategy kind of advisory arm where we help people really think through how this material risk presents itself in their firm, or how to build a blended capital stack at a fund level, where you're combining philanthropic capital and commercial capital, or you have a subordinate share class that is actually paid less than your commercial share class because it's foundation taking that risk. Whatever the case may be, we help structure that.
And it's you know, and also it's like it's really needed, the support that you provide, because, you know, if you can design it and structure it in a way where it's a win-win, where like maybe the portfolio company or the fund, they need that capital at that size and magnitude. The people that are willing to give that money, whether it's a pension fund or an institution or a bank, they're willing to give that money as long as they get paid first, right? So they get kind of the liquidation preference of like a 2 to 3x. And, you know, for them, it's like the risk is kind of mitigated that way. And for them, it's like, look, you just get a 2x on 100 million. That's not that bad. And the payback period is 2 years. Where else are you going to get that type of, you know, vehicle to get that kind of returns? It's definitely not going to be in the market. So kind
Exactly.
of finding those pathways where it's a win-win, right? The portfolio company gets that capital because they're a oil refinery that's, you know, refining some type of clean energy. They need the capital to kind of build it. These financiers are looking for pathways to kind of generate, you know, a 2x in 3 to 5 years. So it's kind of a win-win where you can kind of super connect both of those opportunities.
Exactly. That's a good example. Another one is a foundation actually wants to scale water solutions across the world, and they already have a grant capital that they need to deploy. They could be the guarantor on a vehicle and say, you know, that will protect some of the downside risk, and, you know, if you attract an additional 20 million in commercial capital, we'll double that guarantee, for example. And that helps the other commercial layer of capital and even that pension fund feel even better about entering a market they're not usually comfortable with, or investing in a strategy they previously didn't understand. Not that it can't prove to outperform even, but it's something that, you know, water seemed unbankable, or clean energy still not, you know, doesn't have the 100-year energy track record of oil and gas and coal and predictability, right? So these are the things that we need to fix for, these chasms in financing, or the, as they call, like, the valley of death in certain industries where there's not enough innovation capital or grant capital. And by the way, a lot of these tech companies, all of the ones that have gone public, including SpaceX, really benefited from these type of blended stacks themselves: government contracts, grants, NIH, you know, or government innovating the technology itself. Like,
and then also, I mean, I'd love to kind of go deeper on, you know, some of the philanthropic vehicles. I mean, obviously there's a donor advised funds, which provide some tax advantages. So we'd love to go deep on that in a couple of minutes. But I was looking at your website. I liked how you guys structured these 3 pillars. And I think you kind of touched on them already, you know, kind of in this overview, but maybe we can go a little deeper on these 3 pillars, right? So if everybody goes to their website, you know, you can see, you know, kind of the strategic advisory is what we kind of started talking about. And then Lebec Capital Partners seems like the capital arm, and then the narrative change. So maybe, you know, do you mind kind of going a little deeper, maybe double clicking on those 3 pillars? And I would assume some of those pillars, they probably flow into each other as well, right? If you want narrative change, you need capital and probably some strategic advisory as well. So I see them probably cross-pollinating in mostly or many of those situations too.
Absolutely. And that's 100% how we designed it. Our strategy advisory work, for example, last year we worked with a coalition of foundations that are looking to address affordability and resilience in the housing market, and in even access to commercial real estate for small business owners or nonprofits. So we help them build a blended strategy that aims to be 1 billion at its, you know, at its growth stage.
Sure.
But it would start out with bringing players together around a very expensive ecosystem to ensure that people don't have to leave, and that the key stakeholders in the community that are defending, you know, some of the underprivileged are also able to stay. On the investment management side, we are building portfolios of private market funds that are commercial rate, you know, they have a commercial share class, perhaps they have another share class, but for this pillar, they're all market rate against their benchmark, let's say. And we're building systemic portfolios. And by systemic, I mean we're solving all the systemic drivers of climate change: real estate and construction, transportation, power generation, land use and forestry, and I'm sure I'm forgetting something. I forgot the last one. But anyway, basically we're solving for all of the inputs, but also the opportunity sets, right? Like, where it's the biggest opportunity, which country, where is there an opportunity to solve for what we call the brown the brown premium, right, or the green discount instead of it being a green premium, and a brown discount where you're saying like making things accessible and affordable to the bottom of the pyramid so that they can also participate in these transitions. But also we're looking at the diversification of the asset class. So because a lot of people were overweight venture, regardless of whether we're talking impact venture or traditional, we're also seeing a rebalancing in the market, right? A lot of people move to more liquid assets or more risk-adjusted treasuries, whatever. However, others are saying, like you mentioned, there's a lot of opportunity in infrastructure, in more yield assets right now, private credit, some of these enabling environments to the technology ecosystem. We're again looking at it from a specific lens, but from a broader lens, there are now 4,000 impact funds around the world that are both that are private markets, first of all, that are solving for one of these major systems challenges that we discussed, and they are not on their first or even second fund. So we approach the portfolio construction by, one, they already have a track record. They're deep, technical, and niche. So they're, ag tech experts, they're water, they're, private equity in Asia, all of the things that really diversify in our view, and yet are also solving for the very problems that our portfolios today are creating. So we call this a hedge as well to your current risk. We consider ourselves a complement to a traditional wealth manager because a lot of what we look at, they don't see or can't invest in because they're slightly smaller than their, 25% maximum stake they can take. They might invest on balance sheet, but they can't offer it to clients. All these things that make these funds somewhat hidden, even if they're outperforming or benchmarking just as well as the top tier managers of the world, and are doing something in a way that we feel has more alpha potential because they're experts, they're precise, and as you mentioned in this growingly, like you could use AI to write an investment memo, but you can't use AI to build relationships in Brazil or in Africa and learn all the nuances and understand the pitfalls. And we feel the same at Lebec. Like we've built, we've managed, we've failed, we've tested. We're not reading this stuff in a book. We're like out there meeting the managers for 20 years. So we're really excited because we actually, despite all the things that we discussed, some of the challenges in the global, in the geopolitical space locally, we do actually see more demand, and perhaps motivated by the oil and gas crisis and the cost of being an importer of gas at this moment. We're even seeing kind of this fierce reinterest in like, we need to speed up this process of energy independence, sovereignty, clean energy versus slow down. And we're seeing it from slightly different pockets, right? Like Singapore, Brazil, Europe always leading, Africa, like Asia, areas that are sort of taking over some of that leadership from purely the US markets. And we're also seeing US investors trying to diversify from outside the US, from even in, again, the same space we're discussing.
That's great. So with the fund portfolio construction, I'm assuming the structure is like a fund-to-fund structure, and you offer a couple different thematic fund-to-fund vehicles for like potential clients to get access to?
We actually are doing, well, in the narrative change, we are launching a fund of funds, and I'll get to that in a moment, which is also managed by the investment manager. But we are actually looking at more separately managed accounts structures, because a lot of investors have some nuances in how they define some of the, even though we have conviction in the portfolio, we're selecting all the managers. Some people may overweight a region or exclude a region, or want to, or already be heavily invested in climate venture and want to divest infrastructure, water, etc. So we want to make it a little bit more, from our experience, this was one of the pitfalls of the past that we've seen in the industry, like fund of funds, too many things they can say, oh, we don't do this, we can't do the whole thing. We need to allow some customization, but not too much, because we are the experts. However, people in family office and foundations in particular on the endowment side have very specific mandates. So that's why we chose the separately managed account route for now. Eventually, We want to scale to more pension funds and
Mm-hmm.
even allow for more democratization of access, smaller ticket sizes. So we would do fund of funds as well for
Mm-hmm.
decarbonization and resilience. On the narrative change, we call narrative change that really touches all our work. It's really about what is innovative finance? How are these tools important to solving today's problems for all of us, right? These are
Mm-hmm.
systemic risks to our global market. And not just doing that through conferences like Morgan Stanley and has partnered with us to host a lot of educational events.
Mm-hmm.
We work with different stakeholders. We're hosting events around the world, including in Sonoma this week for 50 of the brightest investors in the space who are, everything from Amazon decarbonization team to lower carbon capital to all these stakeholders, California Endowment. But all that to say, we've tried to bring people together around a theme. However, we've also seen that in the commercial film space, podcasts, and even AI as a tool for enabling storytellers to be heard who are not traditionally able to access or tell their story both through media, film, not just documentaries, but like commercially viable stories.
Mm-hmm.
So we are really we're in the construction phase with some great partners who are really excited about this work on how do we both invest more in these stories, but also create kind of a philanthropic vehicle that also impacts behavior change. So you brought up a donor advised fund.
Sure.
For example, imagine this fund, some of the carry gets put into a donor advised fund.
Mm-hmm.
That donor advised fund invests in behavior change around a theme, whether it's, access to healthcare in remote villages or women's menopause, whatever, like Melinda Gates is working on now.
Yep.
How do we invest in the behavior change downstream through grants, through investments in social entrepreneurs, and that can still take that form of philanthropic or market rate capital.
Mm-hmm.
And maybe, I'm happy to go into, if helpful, more about what is a donor advised fund and how it's an additional tool in this capital stack.
Yeah, we'll love that. I think let's do that. And before that, I'd love to kind of double click on the benefits of a separately managed account. So a lot of times I would say the benefits, in my opinion, and you're going to fill in some of these blanks too, but I would say there's a little bit of personalization in some of these strategies. It can be a little more tailored to the individual needs. If someone wants a little more weighting on infrastructure, you could probably offer that type of offering to those people. I do believe there is some better tax efficiencies versus like a typical mutual fund that's like off the shelf. And then sometimes there's, kind of a little more ownership of the underlying securities, unlike mutual funds where the investments are more pooled. And, it's more professional and institutional grade products too, which I think is great. And then I would say also some of the emerging fund managers that are too small for institutions, they have been able to take advantage of these institutional sleeves that could be offered up to the institution. So that way the institutions could actually get access to some of these emerging managers. I mean, historically, as you know, emerging managers have outperformed. If you think about the proportions, you have like a $50 million fund, 5X is going to go a lot further when you get from 50 to 5X of that versus trying to get a massive multiple on like a mega fund, right?
Yes.
So if you can pool a bunch of these emerging managers that are 5Xing in the next vintage, just because of the proportion, and if you can get a sleeve that gets access to that, I think that's going to be very beneficial on both ends. But those are some of the benefits that I've seen from SMAs, and when you're dealing with clients, so we'd love to, if there's any other hot benefits to add to that, that'd be great. And then maybe double clicking on the donor advised funds, how it helps both sides, right? How it helps kind of the people that are offering it, and then also the people that are investing into it.
Yeah, absolutely. So 100%. Yeah, we see the separately managed accounts as providing definitely more control by the beneficial owner, right?
Mm-hmm.
They are technically the LP. We're managing like a wealth manager on top of that. We see ourselves as sticky because we are kind of rolling out a strategy over multiple years.
Mm-hmm.
We are doing impact reporting on top of all of this. We're creating all of the portfolio construction tools. We're doing all the research on the systems drivers, the outcomes, and then, creating what will be a consolidated report on top of your financial performance, which is like how much impact did you really have, CO2 emissions averted, biodiversity protected, people with access to water and basic healthcare that didn't, things like this that, maybe seemingly like these non-financial indicators to some people seem less relevant. However, when we look at, in fact, people who do impact invest, it's very interesting to see that like just having that impact data makes them even more happy with their performance. Like the performance could have been the same as some other manager, even a little lower, right? Depending on the person, and that impact really is like, oh my God, this made a lot of sense. I'm sticking with this. A certain connection to that. It transcends not just the individual, but you might be able to connect with your family more, your kids, right? They're like, oh, how cool, daddy and mom are like creating much more than just more money. And that definition changes from or family to family, but it is meaningful. So that's one thing.
One more quick question, Julia. So I was going to ask too before I forget it. Maybe you can work this in.
Yes.
When you're offering these products, what's kind of like the most popular strategy and stage? So is it mostly like public markets, hedge funds, or is it mostly, growth equity or buyout? Is there kind of a strategy when you're looking at these managers and themes and packages that you're packaging? Is there a trend that you're seeing, or is it all over the place?
Yes, we don't do any public markets.
Okay.
So we took the decision, that we, given what we're working on our expertise, we're more excited by innovation and the new ways of doing business than the legacy businesses. Also, there's a lot of people who dedicate their whole lives to public markets, and we feel like we're much better assets kind of to add to that portfolio. So like I mentioned, we partner with different RIAs and financial institutions, and they see us as an expert on our carve out of private market investments into a theme that is impact oriented. So right now we've gone to market with our decarbonization and resilience theme. So we are with conviction around 10 managers. We have more than one kind of portfolio allocation model in that private space. So in some way, this is a unique concept, right? Which not unique to us, but it's like 10 years ago, people didn't think of private markets as like as much of a focus of let's diversify every part of private markets. And, maybe your manager says put 5% in private equity and that's good enough, But now it's like the world is growingly complex. Innovation is complex. And like we discussed, there's more of this deep niche expertise globally. So we build 8 to 10 managers in one portfolio in a separately managed account, private equity, private credit, real estate, real assets, and in real assets that may be renewable energy or sustainable forestry. They're not necessarily all correlated in an inflationary period. So we're looking at inflation risk, geopolitical risk, climate risk, inequality risk, and, currency on top of all the things. And those, and in what asset class are we? We're a little bit overweight, more infrastructure, nature-based solutions, private equity than venture, but we actually think it's a good moment for venture, especially in the space where it's kind of, well, like everything, venture is now retrenching a little, other than in AI. Let me rephrase that. In AI, we still have like a ton of overinflated pricing. But in some other things, you're seeing perhaps a better entry point than the frothiness of 2023, 2024.
And I would say physical AI is something that I'm seeing a lot more. I mean, it's essentially the AI for physical infrastructure. So, car washes cleaning themselves and maintaining themselves on their own using AI.
Right. Or an industrial plant using more AI and sensors to avoid leaks that could be methane leaks or whatever else we're also seeing, or like these kind of high level grid optimization, things that are more complicated for sure. So there's money going there too, and that's still going to be a little more expensive perhaps than some of the other things, but equally as valuable.
Sure. I got a question for you. So when you guys are diligencing managers, what is some of the criteria, obviously on the performance side, and then also just on the team and the person, right? Because at the end of the day, after a while, if you're looking at, hundreds and hundreds of managers, maybe thousands a year, after a while, they all look the same, right? Hey, we focus on impact, we focus on climate, we focus on infrastructure. Our performance is at benchmark. So what is the kind of tipping point where you're like, wow, I want to go long-term and build a long-term partnership with this manager? Maybe they're on fund 3 and we want to build this long-term relationship to get into fund 5 and fund 8 down the line. So what is kind of the DNA of a manager that fits the criteria for Lebec?
Yeah, great question. I think like we mentioned, maybe I didn't say this, but on top of Alix, myself, we have another managing director in Munich named Rafia. Hannah, who's in Kansas City, helped build water equity. All of us, including our partners, have pretty deep roots around the world. So some of the things that we've been doing is already over the past 20 years, kind of watching some of our favorite people grow in their firms.
Sure.
So, one firm in what I'd call the pioneer of impact investing in Brazil, now they're, on their 5th or 6th vehicle. They've done public and private markets. They just partnered with the Nature Conservancy and are doing a really cool nature-based solutions fund in LATAM. And I've known and watched them hire and go through difficult periods and like face all of the ups and downs of this industry, which are even harder perhaps than a traditional manager, and still stick to their values and keep trying to be better and standing by their authentic selves. So I think we very much help we prevent people from investing in greenwashing in our view, because we're so deeply connected to the issues and understand some of their drivers that we tend to be able to weed through those type of things quickly. So we do look at funds that have been established previously for the most part, although we will in the long run look at more emerging managers. It's just, there's other headwinds to that right now, because we really want to build portfolios that attract institutional investors that are comfortable taking usually not that first check risk, but, 3rd fund, 4th fund risk.
Yeah.
Where they do have an impact team. And I love, there's one manager we were just with in Paris where they were saying, our impact person and our investment committee are one. They're not like, here's a check mark and here's a check mark. Like, we work together, we look at every deal as one. We value things as one, and we measure through the life cycle of investment. I think that's another thing, like checking a box at the beginning and not working through the whole life cycle to exit, to maintain those two things in balance as best possible. There are trade-offs inevitably, right? In every business, there are trade-offs between making perhaps the best decision for everyone and for the business, for the plan and for the business, but where that's constantly in check, and that's something they measure and manage, where perhaps they don't have, where they may also combine like solid financial experience, like in an asset class, with leaders who have really thought this through from a science and impact perspective, where their thesis is deep, to your point, yes, and not mega funds. So we actually don't do any mega funds, where there might be generalist top-down investors.
Yeah.
We want people who know the people on the ground, who've been there, lived there. We're looking, as we know, emerging frontier markets. Well, we're not doing a ton of frontier, but markets outside of the even more traditional. And even today, I would say that's no longer even applicable.
Sure.
A lot of surprises in today's world, and we have to be nimble and ready to deal with them. But we also need to partner with people who understand the complexities of their local ecosystems.
Yeah, what I'm pulling out from that too is, maybe just advice to managers is just, although you don't get a check immediately, keep them in the loop. Maybe have a newsletter, speak at conferences, be where the investors are, because they're watching, right? Like you said, it's really interesting. So we had an LP come into one of our fund accelerator sessions. This LP has done really well. I mean, they've built, I think, a couple platforms, but like this person was based in is actually based now in Portugal. And, what he told me was, he was like, look, I met a manager that I was kind of following, and I was like, hey, do you want to get coffee? I'm in town. And the manager was pretty much like, hey, I'm not raising, so we probably don't need to meet. But, they observe not only just kind of what you're doing on social media, what you're doing at the conferences, what you're writing in your newsletter, but just your character traits in terms of just being a human being. It's like, you can still meet with somebody or grab coffee to see how their family is doing, see how they're doing as a human being, even if there isn't a transaction, today, right?
Yes.
So I think it's just investing in the human and the relationship is, I think what LPs also observe too, because it's a long commitment, right? Oftentimes longer than a marriage. So
Yes, that's such a good point. That's such a good
yeah.
point. Yeah, and I was thinking, in today's world, one of the other societal challenges is loneliness and kind of disconnection, and
Mm-hmm.
the world of raising capital is always really hard, right? Because you get a
Yeah.
lot of rejection. So I think that is also a lovely message to not only stay connected for purposes of eventually, hopefully getting a check, but just to, connect with people on a personal level. I think in this transactional, fast-paced world is
Mm-hmm.
not necessarily more relevant, but I think COVID made everyone so isolated.
Yeah.
We were on Zoom, nobody was seeing each other. Now it's like I feel that it's more important to go back to flying to the place, seeing the person, sitting down and really connecting both with the manager
Mm-hmm.
on the diligence side, some of the portfolio companies, some of the people they impact, but also the LPs, our clients, our Lebec Capital Partners clients, the investors, their kids, right? The next gens.
Mm-hmm.
And I think that'd be another piece of advice for people raising capital, especially in VC and another sort of like innovation. The next gen, Goldman put out a report that next gens want to invest, or let's call them millennials and Gen Z, 20% of their assets in alternatives or in private
Mm-hmm.
market versus prior generations are more conservative. Naturally, they're also older, but they're getting most of their information from social media. They're not necessarily even getting it from a financial advisor.
Yeah.
So it's interesting. That's why we also see a niche here. It's like they're not necessarily diversifying or professionalizing this officially, but they are wanting the exposure. So there's also like, how do you get in between that in that conversation?
Yeah, and I mean, there's a handful of really large institutional families that I think you and I mentioned earlier, but I mean, many of them are also investing in their own brand. And believe it or not, some of that content is going out on social media. They're doing storytelling in a short form, digestible format, and they need to kind of evangelize kind of the great work that they're doing. And that's an initiative. It's a strategic initiative for many of those platforms because they're looking to kind of build kind of a in a legacy, because they may have next gens as well that are going to probably take it on as the next CIO 10 years from now. So
that's such a great example. Yeah, like engaging, and that's narrative change for us, right? Engaging on new forms of media to also change the way people are thinking about what is possible. I think we're thinking about Mars, but what else is possible with your money? What else haven't you thought about? How else have you not aligned perhaps your personal, professional, and even societal goals with the way you invest?
Yeah, absolutely. Well, Julia, hey, this was so amazing. Really learned a lot. I'm very confident the community has been inspired, and I think we covered a lot of topics. So thank you so much for your time, and excited to have more and more of your team members come on and tell us and keep us updated on the great work that you guys are doing.
Thank you. Same to you. And it's been a real pleasure. I look forward to many more conversations.
Likewise. Thanks so much, Julie, and everybody else. Have a great day.
Ciao.
All right. Take care. Bye.
Take care. Bye, Joel.